Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBethMcLeodPartners.com. Welcome back to the show, Hilliard.
It's great to be on the show.
And Hilliard, are you on Twitter?
Yes, I'm at, it's called @HMACBE. And after this interview, I'll tweet a chart that I'm going to refer to in the interview. So there can be some interactivity between Twitter and our talk.
Hilliard, we heard from the big banks not all that long ago that Canadians took the opportunity of the pandemic to bolster their savings accounts. But what's the latest on that?
Well, the latest is that was never correct anyway in the first place, right? So, but what was frustrating for some of us was that we were pretty sure that there just wasn't this huge pile of cash. One bank CEO referred to it as a coiled spring of buying power waiting to be unleashed into the economy. And then, of course, a lot of the economists that are highly paid in society actually work for the big banks. And they would refer to that as well. And there was some evidence that some bank accounts had a lot of cash in them. But it didn't make sense in the sense that the average person actually was suffering quite a bit in the recession, a very severe recession that hit a year and a half ago. So it was a bit of a mystery. But it turns out that now that more data are available, really it was only the very wealthy people that had all this cash piled up in their bank accounts, and the average person was actually going deeper and deeper into debt. And we got the first clue of that about 2 weeks ago, maybe 3 weeks ago, when it was published, the increase in mortgage debt. So people were paying down their credit card debt and refinancing because we had an uptick in housing. Amazingly, we had an uptick in housing during the recession, so people used that opportunity to pay down some of their expensive debt and add to their cheaper debt, mortgage debt at 1.5–2%. But they were going more deeply into debt, and the numbers year over year, for I think June or July was the last month reported, was something like 17%. It's just never happened before. We've never seen such a big increase in debt in probably in the history of Canada ever. So on the one hand, you've got people working for the big companies saying there's a pile of cash. On the other hand, you've got this incredible surge in mortgage debt. The two don't add up, obviously. And so what it really turned out was that it was only we're not even talking the 1% here. We're talking the 0.1%. We're building up cash. Probably one of their biggest expenditures in that category is travel, and they just weren't able to travel because of COVID, or they didn't want to, and so they just kept building up the cash. And of course they're always big savers. They're not big spenders anyway. And but the big spenders are the people that live paycheck to paycheck, and they were going deeper and deeper into debt. So hopefully I don't think that's going to get the same attention that all that talk about these massive piles of cash got a few months ago, unfortunately. But that is the reality, and it's much different from what we saw on the front pages of many newspapers.
What's the financial implications of this? Then we had a distortion where they said people were saving and paying off debt at record levels, but did they pay off their credit cards and then acquire a house?
There was a lot of buying of houses, and that's where the big surge in mortgage debt probably comes from. They certainly took the money from the government and maybe levered that up to be able to buy a house. early on in this thing, there was I don't know if we've talked about this before, but there was a loan, I think it's $30,000 to independent business people for sole proprietorship, small business. Example would be a taxi cab or something like that. And I was talking to somebody in Toronto back then, this would be probably a year ago at least, and he said, "Oh yeah, we're taking that $30,000 loan and we're buying a townhome for now they had to add a little bit extra to it. I think the number of 900,000 was mentioned. Townhomes for 900,000. So they were getting 50,000 down and getting a $890,000 mortgage and buying a townhome. And of course, the purpose of those loans was not to go out and buy real estate. So they're going to have a problem. I think the loan runs 3 years or something, and then at that point, some of it's forgiven if you use it for the proper purposes, but if not, then the whole thing must be repaid. So there'll be a reckoning there. But I'm sure that the people that were doing it are and perhaps they're correct, I don't know, believe that they'll be able to flip the property before they have to face the government in terms of that loan that they took.
We'll have more with Hilliard MacBeth right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Hilliard MacBeth. Hilliard, so many government decisions are made on the advice of economists, but economists only use numbers and figures that they've gathered, databases, and so on. Does this actually lead to good policy or realistic policies?
Well, the economic world, one of the top jobs, when I went to graduate school in economics, the outlet was for the PhD graduates, which, by the way, I didn't hang around long enough to get that. I was too impatient. The outlet was to go and work at the Bank of Canada and work going to monetary policy. So that was the best, and that actually was a pretty good career. And the other outlet, which was tougher, it was the academic outlet. But some of them that get to be into the central banks do really well, and they become famous, like Alan Greenspan who was the longest serving governor of the Federal Reserve in the U.S. And I was thinking about this phrase, irrational exuberance, that he, because it fits so well in today's markets, he coined it in a speech in 1996. And one of the things, the speech is actually really quite interesting because it predicts a lot of what is happening today. And of course, in 1996, we were just prior to the dot-com bubble of 2000, and the similarities between 2000 and today are very similar in terms of the valuation of the stock market. But this is what he said. He said, and I'm quoting here, "It is generally recognized and appreciated that if the Federal Reserve's monetary policy decisions were subject to congressional or presidential override, short-term political forces would soon dominate. The clear political preference for lower interest rates would unleash inflationary forces, inflicting severe damage on our economy." End quote. So we've got low interest rates, we've got inflation. The only thing we don't have yet is the severe damage that comes after inflation. And I don't know how it happened. So obviously central bankers were aware of this. And they, if you look at the Bank of Canada, the Federal Reserve in the U.S., Bank of England, their top job, their only job really, is to maintain the purchasing power of the currency. In other words, to keep inflation low. And they looks like they're on the verge of really messing up badly in that respect, because the money supply has grown to something like 30% in the last year. And as we just talked a minute ago, mortgage debts are soaring at double-digit rates, almost 20% annually. So there's something going on, and house prices were up until recently inflating at similar rates. And the central banks are, one could point the finger at them and say they responded to short-term political forces, kept interest rates too low, created a burst of inflation, and then how do we get out of this? How do we resolve that? That's going to be the question the next year or two, unless the inflation turns out to be temporary, as all of the central bankers have been saying. But it's unlikely that the economists that work at the central bank will have any way of really estimating what's really going to happen. The equations they use do not fit the real world. They fit this imaginary world that they have created, and inflation and things like that don't really fit that well into the equations that they use.
Well, for example, the government's official cost of living index doesn't include housing, it doesn't include fuel, it doesn't include taxes.
Yeah, they've got this convoluted way of doing it. They've got housing, the cost of housing, they call it shelter cost in there, and of course rent is one. And they've got a complicated formula that they use, which I won't get into, and people can look it up if they want. But one of the key factors that people don't realize is in there is the mortgage interest rate. So in other words, it's not like the cost of housing in terms of the cost of a house going from say $500,000 to $1 million over the last 10 years. But it's the monthly payment that they're looking at. So if the mortgage rates come down from 5% where they were 10 years ago to 1.5% where they are today, the actual monthly payment, even though house prices have doubled, is lower than it was when the house cost $500,000. So the monthly payment on $1 million house is lower than in the inflation index world, that actually is not inflation, that's deflation. So and that by the way is the biggest weighting in the CPI. The shelter cost is around close to 30% of the total. Now they do measure things like gasoline and food and all that kind of stuff, but they have all of these different exceptions. They say, well, leaving out the volatile components like food and gasoline, inflation isn't that bad.
So there seems to be a real disconnect with reality.
Yeah, it's what I was told when I entered graduate school was an economist is somebody who's never actually met a real person but has had one described to them. So they don't actually deal with real people. They don't actually deal with the real world. And it's not fair. I mean, there's lots of great economists out there. Greenspan, by the way, we were talking about him, he wasn't really an economist. He didn't even, there was some kind of controversy over whether he even had completed his PhD thesis. Nobody could find it. He was more of a politician. But he at least understood it enough to know that it isn't the scientific thing where you can have a bunch of equations. There's a whole bunch of other factors involved. And if inflation expectations get elevated to the point where people start to believe that inflation is going to be strong and keep getting stronger, people change their behaviors, and that is the most dangerous thing. And the central bankers all used to be aware that that's the most dangerous thing that they must never let get entrenched into society, is this idea that house prices of any, whether housing, food, gasoline, anything, if people start thinking it's going to cost more 6 months from now than it does today, and it gets embedded in their psyche, then you've got a runaway inflation. And then you have to do something like they did in 1980, 81 when they jacked interest rates up to 18, 19, 20% in order to break those expectations. It was a very painful exercise to get that inflationary expectation defeated and broken. And it caused a severe recession, and it caused a lot of difficulty for a lot of people.
Well, they also brought in wage and price controls, and I remember at the time, my wages didn't go up, but prices still did.
Well, they had that in the 70s. The inflation in the 70s was extremely persistent, and it was mostly because the oil prices jumped from $2 a barrel to $10 a barrel, and in those days, the economy was much more intensive on oil prices. Today, we're more into, cars have better mileage. Some of them are electric, and so you don't really see it as much if the oil price goes up. But in those days, you only got 5 miles to the gallons. you had to refill every half hour almost. So if gasoline, if the oil went from $2 to $10 a barrel, you really noticed it right away. And the OPEC was the culprit, and inflation ensued, and it went on for a long time. It actually went on for 7 or 8 years, from let's say 74 to 81, before they took the drastic actions of breaking the back of inflation by raising interest rates so high. So I hope that isn't what we're heading into, but certainly the irrational exuberance in the housing market, and it's not just Canada, although Canada is much more extreme, but even the U.S. has got a new housing bubble after living through the crash that they went through in 2008. Australia's had a housing bubble all the way through, same as Canada, and then the stock market, of course, is experiencing irrational exuberance again as well. So it's looking more and more like we're going to have to go through one of those cycles.
We're about 2 weeks away from casting our ballots for a federal election in Canada. Have any of the federal parties come up with housing policies that seem to be workable and affordable?
Well, the big thing that everybody, the easy thing for politicians to look at is to respond to the outcry that you get from developers, which is we need more supply, because developers love that because they can build more stuff, and they can get it's usually the municipalities that control the rules, and they can get the more senior politicians to put pressure on the municipalities to relax the rules and allow them to develop more product. But really, that wouldn't do it, because there's always going to be, especially if people expect prices to be higher next year than they are this year, they're always going to want to buy, no matter how much product you give them, they're going to want to buy more, and then there's speculators and foreign buyers and all this stuff. What you really need to do is to break the availability of credit. So we talked a minute ago about mortgages going up 17%. Well, that doesn't make any sense. The economy is growing at maybe 3 or 4%. Mortgages are growing at 18%. That's an unbelievable disconnect. So what you need to do is actually to restrain the amount of credit that's going into housing. And of course, it's been the most important thing in the economy for the last, there's been several headlines recently about how the investment in housing and residential investment has been propping up the economy. So politicians don't want to do that, and there's nothing in any of the platforms that would break the buying power side, the demand side, which would, other than for foreign buyers, but for the domestic buyers, they wouldn't dare touch that idea. But they could easily do it. They could just go to the lenders, the big lenders like the banks, and instruct them to stop, lending, 8 times family income, and restrict it to 3 and 4 times family income, as I recommended in the summary points I made in the second edition of the book. 3 or 4 times family income used to be the upper limit, and if that amount of credit was the maximum you could get to buy a house, house prices would have to come down to match that. And of course, that would not be popular with people that already bought houses, because we're looking at a very large drop in the house price of houses. But that's how you would get out of this housing crisis and restore affordability. But I don't expect to see it in anybody's election platform anytime soon.
Isn't something like 70% of the Canadian population a homeowner?
Yeah, there's certainly there's about 13 or 14 million households, and 8 or 9 million of them are owner occupied, and the other ones are rentals. So you'd be looking at I don't know how many votes there are in those 8 million households, but let's say there's 2 each household. It'd be 16 million votes. I don't think you'd want to risk that. So it's not going to be something that the government does. It will have to be something that just happens, and that's what happens. Every bubble, for some reason, reaches some pin that bursts the bubble, and I don't know what it'll be this time. It's often after these bubbles burst, you can't even after the fact, even with all the information available, you still can't even really determine exactly what it was that caused the bubble to burst. But they all have this life cycle, and they reach a point. Would be probably in the housing market would be not enough new credit available to keep the prices here, because if prices go up 17%, you need 17% more credit for every new buy to keep the. It's a treadmill that's turning, and the speed of the treadmill keeps increasing as the prices go up. You need more and more money flowing in, whether it be from the foreign buyers, the speculators, the first-time buyer. You need that new money coming in all the time, and eventually, like any Ponzi scheme, it collapses because the speed of the new money coming in isn't fast enough to keep up with the bubble growing, and it starts to burst. And once it starts to crack, then things happen fairly quickly usually. But the unknown factor, as we saw in 2020, a year and a half ago, was the government stepping in and flooding the bank accounts of people with money so that they didn't need to they didn't get into trouble, and they didn't need to sell their homes. So if it happens again, would the government step in to the same degree and run a $340 billion deficit? I guess we'll see when it happens.
Well, I think it was cheaper for the government to let people keep their homes and have a place to live instead of having to build a whole lot more social housing to house those people who lost their homes.
Well, what happened in the U.S. is that people lose their homes as owners, but they immediately turn around and move back into them, sometimes probably even the same home, as renters, right? So, it's just that it would be much simpler just to change the paperwork on the title so that people could stay in the same home. But instead of being owners at $1 million, they'd be renting a house that's worth $600,000 or some number like that.
Well, I believe in Britain they found it was cheaper for people to stay in their own homes and not have the mortgage default than it was for them to have to build social housing, because they do that in Britain, council housing, which most people don't want to live in, but will gladly if it's the only roof they can get over their heads. So there were actually millionaires who would default on a mortgage because the government would pick it up.
I don't know about that, but they wouldn't need to. There's certainly been enough. The problem in Canada has been there's been lots of investment in residential housing. Residential investment as a percentage of GDP has reached 10%, and no other developed country in the world is anywhere near 10%. The U.S. is up to 6 or 7%, which was the peak in the last cycle, and Canada's been above 6% for now for more than 12 years, and it's recently hit 10%. So we're not. It's not a shortage of investment into the housing market. It might be a mistake in terms of the type of housing. So if people really want to live in 500 square foot luxury condos that they're trying to sell for $900,000 close to the center of downtown, I don't think so. But if there was a major shakeout, there's certainly those places could be rented out to people that maybe had lost their homes, and it would all eventually. We need the cycle to be broken, and then we need to restart at lower prices. And there's no clean and pain-free way of doing that. There has to be some stress, but with stress and difficulties and adjustments like that, that's where you get your opportunities. The problem with today is there's no opportunities. I mean, other than the greater fool theory of investing, which means I'm going to pay a ridiculously high price because there's an even greater fool coming behind me that will pay an even higher price than the one I paid. But that's not a very good investment strategy. The better investment strategy is that prices are cheap and you get to swoop in and buy something up cheap. And the only way that situation can be created is if there's a crack in the bubble and prices come down.
Hilliard, thank you so much for chatting with us.
Nice to be on you, and I'll send out on Twitter. I'll send out a copy of Robert Schiller's, who wrote Irrational Exuberance. And now this is about the stock market, not the housing market, but it's a measure of the valuation of the stock market. People can see how much froth there is in the stock market as well as the housing market at this time. So close to the record highs that were reached in 2000 in terms of valuation.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. If you have any questions for Hilliard, you can email them to us and we'll ask that question for you at info@howstreet.com. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at Howe Street. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.